Hey, everybody. Happy Monday. Good Memorial Day, everyone. We had the day off, so to speak, and we're getting ready for what will be a raucous week coming up. We've got the word of the debt ceiling, the agreement being made. It's being sent to the Senate. We're going to see a lot of volatility, not just because of the debt agreement, but what does this do to bonds? What does this do to the buy the rumor, sell the news? What is the aftermath of this? And then on top of that, we've got non-farm payroll coming up this Friday. So when we think about those scheduled high impact, high volatility events that are on the calendar and that are going to affect volatility, whether that's a 5-minute, hourly, or daily time frame, we know we're going to have to deal with a lot of opinion for lots of different reasons, whether that be the macro of the rate of change of jobs and average hourly earnings and the unemployment rate, or whether that be, what is next in terms of the debt ceiling. I did a little bit of research. Some of it I remember, and some of it I just frankly don't. And I was looking back at the last 10 times there was either a debt ceiling suspension like we had in 2021 July, or whether we had a bill passed to raise the debt ceiling like in 2019, October 21, and December 21. And what happened to the S&P in the wake of that? I mean, obviously the immediate response is a sigh of relief rally, if you will. And I don't know that anybody here is going to be surprised to see where the S&P sits as we go into tomorrow. The question is for how long. Now, inevitably, now that the S&P futures have reached 4,200, right, the next question becomes 4,400, right, or whatever would take out the August 22 high, which is sort of the near-term high once we got past 4,200. So we always love thinking in these double zeros, and that will likely be the next one to come up. We have a handful of FOMC members throughout the week, but nothing is going to really overshadow the ongoing debt ceiling conversation. And then obviously going into, on this shortened trading week, non-farm. All right, so that's what we've got coming up. I mean, anything that we would have thought, I write a newsletter really for myself first, and now we put it out there to members, but I write a newsletter. I have a series of notes that I put together for myself. And then whatever I had the sort of the framework of it. Whatever I had Friday evening, Saturday morning, whoosh, pretty much out the window, not in terms of technical levels and of the watch list, but the overall expectation that now it's a rising tide. And are we going to start to see some bargain hunting in things that have been just absolutely annihilated as of late relative to tech, right? Like financials, healthcare, and even industrials. Industrials, we've started to take a little bit more of a bullish take on due to some of the PMI and ISM numbers, but definitely something that I'm asking myself, if we're going to see the rising tide continue in tech, at what point does it, we get the escape velocity from, we see XLK, XLC, XLY, SMH taken off. At what point does it start to move over to financials, healthcare, industrials, transportation? All right. With that being said, as always, gang, the show is about your questions. So let's get to them, shall we? And first one up is, hey there, Howard. Can I take a look at the 6E? Sure. And by the way, gang, if you want to take a look at the daily, if you want to take a look at the 5-minute, I don't know if any of my my Twitter peeps are out there or not. We had a monster tweet thread that I put out on, I guess it was yesterday, about 2 p.m. yesterday. And it was really about day trading. And I think a lot of folks think, oh, well, then all you do is day trade, Rog. Oh, gosh, no, right? It's what I like to do the first hour and 5 minutes after the bell. And then moving on to an hourly, moving on to a daily is far more easy when I'm not distracted by sort of the frenetic action of an intraday time frame. So it depending on what time frame you want to look at. Howard, let's just jump into the daily if that's cool with you. All right. And uh, look, if we have the Fed pivot coming, which, oh gosh, with the debt ceiling conversation, that really just got pushed aside. And yet the June and July target rate probabilities from the Fed fund futures are showing about as hawkish a look as we've seen for those two meeting months as there's been in some time. We are expecting another quarter point hike, gang. It's pretty much looking at this point baked into the cake. And yet here we are moving higher on the debt ceiling. So once this debt ceiling narrative is played out, the ceiling is officially raised, and we find out by how much, for sure, at that point we could start thinking about how much printing has to happen. But really, we will then move on to the target rate probabilities. And you've got to wonder at this point, with the debt ceiling raised, does this, and there's the wild card is this could actually negatively impact inflation, right? I played out a couple, three different scenarios as to what happens after the debt ceiling. It's interesting too. Never has a debt ceiling actually led to a recession. Debt ceiling increase led to a recession. I wasn't sure about that, so I did a little bit of research on that as well. All right, so 6E. I mentioned all that, Howard, because if the Federal Reserve is still in maybe November or maybe early next year, planning on that Fed pivot, if we are moving into a pause, say after July, there's no meeting in August, that means there'll be a pause in September, maybe a cut in November, who knows? At some point, it doesn't just have to be the U.S. going into an accommodative monetary policy and cuts, pauses and cuts. That doesn't need to be the sole reason for the euro to keep moving higher. The European Central Bank, as opposed to the Federal Reserve, they are still in very much a hawkish upswing in their monetary policy. They are still fighting inflation. They are still really looking at more rate hikes. And that alone, when you have a hawkish central bank, as the ECB is, contrasted with a central bank that's on the tail end, maybe the last quarter point hike or two, that's where the euro can continue its climb. And that is exactly what I would bet on, quite literally bet on. I would want to take advantage of support confirmed, say, here at the 200 exponential moving average. Those white dots are a fast EMA and a slow EMA, the 8 and the 200. When they cross and interact with price, the dots turn on at the spot on the chart that a 200 exponential moving average would be. So it turns on and off, unlike the EMA. I would look for a price pattern like an inside candle or a minor low in this area. But yeah, I want to get long the 6E. We can take a look at FXE calls. We could also possibly take a look at UUP puts. That would be the same narrative. Euro goes up, dollar goes down. It's the strongest negative correlation in any market. So that's what I would do with 6E. I want to buy it, or on the flip side, I want to short the dollar, US dollar index, UUP, DXY, DX futures, etc. All right. Next up, JJ asks, any thoughts on Tesla? Sure, technically. All right. Thank you for the question. Tesla has been the laggard, right? So here I've got the 1 hour chart on the left and the daily time frame on the right. Tesla is still below the 200. And let me show you something here. I know this chart's going to look a little busy, but just humor me for a moment. I'm going to take you on over to what I call the multi-chart of the XLY. So this is an arrangement of the XLY in the upper left-hand corner. That's the tide, as I like to call it. And then I've got the individual boats. And these are the individual stocks weighted in their order within the XLY. Now, remember, most ETFs and all the indices, Dow and NASDAQ, S&P, I shouldn't say all, but Dow, NASDAQ, S&P, are high concentration weighted. Meaning, yeah, there's 500 stocks in the Dow, but about 20 matter. Yeah, there's 100 stocks in the NASDAQ, but about 9 matter, right? Because of their disproportionate weighting relative to the other stocks in that group. Consumer discretionary is no exception. Amazon by a landslide, Tesla by a landslide. These are, if you want to add Home Depot in there, those two stocks, these are the movers. These are the cylinders, if you will, that have to fire to move the engine called the XLY. Amazon's above the 200. We had talked about this at length a couple weeks back, and waiting for that break of the 200, which is really almost like flipping a switch. Almost, to me, it's the equator, bearish hemisphere below it, bullish hemisphere above it. So Amazon's able to move higher, and that should alone be able to do a pretty admirable job of keeping the XLY bullish. But the other two, Tesla and Home Depot, you got some laggards there. You've got Nike not looking very pretty. So right now you can see how CMG is not that heavily weighted, but between CMG, Amazon, and maybe some neutral chop out of the likes of, say, Lowe's or O'Reilly or Booking, you've got Amazon doing all the heavy lifting here, right? Now, I mention that because remember, if XLY goes lower, Amazon goes lower. If the NASDAQ moves lower, if the S&P moves lower, those are tides going out against the boat of Tesla. Tesla's at the 200, and this is really what I'm curious about. So you can see the group that Tesla's hanging out with. Do the broader averages need Tesla to move higher through the 200 to continue? Everyone, this. The NASDAQ has been fine without Tesla participating. If it did, that would be better, but it doesn't have to. So if I'm looking at Tesla for the sake of looking at Tesla, take a look at the year. Going back for just 2023. 1, 2, arguably 3, 4, 5, maybe. This could be the 6th time we've approached or gotten in the neighborhood of the 200 exponential. In this case, the 8 and the 200, my slow and my fast EMAs. That many times in 2023, we've gotten to this level, and you can see the answer every time Tesla's knocked on that door. Whoosh, it's go away. This time, though, we are dealing with possibly that rising tide. So if we get that off the debt ceiling, maybe non-farm payroll suggests that the Federal Reserve shouldn't be as hawkish as we were expecting in June, July. There's lots of interesting things that could happen this week that could help propel Tesla over 200. But let's presume in a choppy environment with an overbought slow stochastic, or whatever your preference for overbought or oversold is, or maybe the fact that here we are at the 2023 point of control, which is sitting just an inch, it seems, below the 200. There's a lot of reason to think there's a ceiling overhead. There's a lot of reason to think there's supply and resistance and sellers overhead. So I'm going to presume the market stays in that range. I'm not going to presume the breakout, right? And that presumption is not random. That presumption comes from this is still a neutral environment. Even though Tesla's rallied, it's rallying within the context of chop into a ceiling. This is where I would use specifically indicators designed to help identify overbought and oversold, and then what price levels would tell me where traders could start to sell. Volume-derived levels like the point of control, even that 200. Look, there's a lot of folks who would never consider themselves chartists or technicians, and yet they love that 200 exponential or simple. That particular indicator transcends technical analysis. So I'd keep a really close eye on that. If we have a significant rising tide, Tesla could be the beneficiary of that, because we are right at the precipice there. But I'm going to presume it stays stuck for the most part in that range. All right. So yeah, lots of moving parts. I think the idea that we can look at an individual stock without looking at the index and the sector and the other stocks it moves with and its weighting, to me, it's going to put us at a handicap to understanding what moves the market. High concentration weighting moves the market, and other stocks will be moved by other stocks depending upon their participation within a sector or an index. So I always want to look at not just the individual stock, but what's around it. right? What else will move? Walmart, as far as Walmart goes, I tell you, Mark, yeah, it's neutral. Uh, well, it's neutral on the daily. I actually would look at this as a trend. The trick is where do I want to buy this? And in terms of as close as we can get to about 144 or as close as we can get to the 200 might be interesting. Although I'll say the last handful of attempts around the 200 really were not showing that that level is where decisions were being made. I don't really have a super clear plan on Walmart other than to say Friday was an inside candle. And if we're going to see movement higher after 10 a.m. tomorrow, I'd like to see Walmart take out the Friday high, which would be 146.82. So I want to see after 10 a.m. Movement higher through that level. And that would confirm an inside candle breakout for me for a short period of momentum to the upside. And if that attracts more buyers, because a lot of time momentum begets more momentum and momentum attracts buyers and buyers attract more buyers. I mean, that's sort of the way in which the market feeds sometimes, like piranha. If we get a decent amount of Momo, Mark, that could be the way to go. If we happen to break Friday's low, 145.5, or even Thursday's low, basically 145.10 or 145, I would start all over again, hit the reset button, and look for a new price. Look for a new price pattern. All right. Andres says, "Hi, Raghee. How do I trade the HPMR levels? Do I fade them? What's the criteria for not fading them?" So, Andres, everything I teach. So, for those of you that are not familiar with the HPMR, it's a simple arithmetic formula around 6 months of historical price movement ranges. So what is the movement going back 6 months between 9 and 10, 10 and 11, 11 and 12, 12 and 1, where I get a historical look at the specific hour of the day? It's a simple arithmetic formula, but again, the data that we're curating is what puts the red and green zones on the screen. All right, so what do I do with them? Well, I'll fade them if we're in chop. I'll prefer the red in a trend and I'll prefer the green in a trend. So I'll fade them for the most part, but which direction would I fade it with? That goes down to the structure of the market, right? So I won't fade both sides, right? I think one of the most important things for day trading, which is what I did the thread on over at my Twitter feed, is trading less, not embracing stop and reverse, slowing things down, having a directional bias, knowing why, based on just really some simple criteria, knowing why I would perhaps want to be a buyer over a short seller on a particular morning. And then that's where an anchored VWAP or the hourly price movement range can be really, really helpful. So my criteria for not fading them, Andres, would be the same criteria I have for not fading, period, which is in a trend. If it's an uptrend, I'll buy support. In a downtrend, I'll short into resistance. It's only in chop that I'm open to one or the other side. All right, next up, MG asks, would I have taken a long on the ES 1 hour daily price movement range Friday? Would I have? Well, I'm not. So let me be really, really clear. I am not in that trade. But the question is, would I have done it? All right. So just as we talked about the hourly price movement range, along the same lines, almost like the big brother of the HPMR is the DPMR, the daily price movement range, as opposed to the hourly. And here, once again, I go back six months and I look at the price movement range for a Monday, the Tuesday, the Wednesday, the Thursday, the Friday. And that's what gets plotted on the screen. So on Friday, here's Thursday, by the way, going into Friday. And based on price in that gray area, yes. Was I going to? No. You know, the problem with going long on a Friday, trader, Friday hates traders kind of thing. Either we end up with a debt ceiling agreement over the weekend. And I remember telling my traders in the room, look, if there's a side that I don't want to be on, it's for the most part the short side that I don't really want to favor, because I think the risk to shorts is that, look, gang, we've had 108 debt ceiling increases since what, the 60s or something? I don't hold me the actual date, but it's been at 108, I believe, is the number. Going how far back, I do not recall, but we've been on this ride before, right? We've seen this movie before. We know how it ends, right? And so the debt ceiling crisis at some point coming to an end with some kind of agreement, that, I mean, we knew that was going to be the way this ends. Just didn't know when and by how much, and whether it's going to be a kind of a 1-2 punch like in 2021 with the October, December, that type of thing. But we pretty much knew what was going to happen, right? So that's why I say for short sellers into the weekend, the risk is more so to them than a long trader. I'm not in it, right? But if that was something you were comfortable taking risk based upon, right, that would be the support level. The challenge is, we really need the neutral environment. So I'm not in it, MG, mainly because I just did not get a clean move. And without that clean move, I think it was far easier to be long tech, to be quite frank. MG, so let's get into a little bit of detail as to why the preference for the QQQ, Rog, why the preference for NQ minis or MNQ micro, because the pieces of the NASDAQ are far more organized and bullish than the pieces of the S&P. XLK, XLC, XLY, SMH all keep the NAS moving, and they're in agreement. They're bullish, they're in uptrends. Contrast that to the S&P. Yeah, XLK is in an uptrend, and that's the number one weighted sector. But financials and healthcare, especially healthcare as of late, there's not a lot of strength there. And without all three of those moving higher, the S&P is in a bit of a tug of war, right? Can XLK overpower the weakness of financials and healthcare? Can tech overpower? Or if I know tech is where the strength is, why not just leave financials and healthcare aside? That means leave the Dow, leave the S&P aside, and just focus on buy the dip in the NAS. So MG, I would say my bigger issue is not what you pointed out in terms of the buy. I think you're absolutely correct. But if I'm playing relative performance, which is the heart of my watch list, if I'm asking what's the best example of stocks that I could buy, well, not involving healthcare and financials would be a part of it. The easiest way to do that would be go right into those sectors, K, C, Y, SMH, right? Or the NASDAQ itself. So, if the NASDAQ set that up, that's a whole lot more interesting to me. I hope that makes sense, MG. I think sometimes the question is, what did this stock do needs to be preempted, if I may say so. I know for me, what helped me is don't fall in love with a stock. Ask myself, what makes this stock worth my time, attention, money? What makes this stock better than other stocks in that index or sector? How has it earned my attention, right? Is it the best example of an uptrend or downtrend? Does it have the clearest path? Is it earnings in the rear view mirror? I don't like to trade earnings, right? Many of you know that. I don't like the binary, lottery scratch off ticket approach to earnings. It's just not my thing. I'd rather wait till after earnings, 1 or 2 sessions, and see how, as the dust settles, if there's an opportunity there. So I think that process of why S&P versus NAS, I know I kind of deep dove that, but really important to me, MG. And then even more importantly, can I find a relative outperforming sector and or stock, right? We played Apple. That was the only position we took over the weekend. We had a swing in Apple. That was the only swing. So we did quite a bit of day trading last week, but the only swing overnight trade that we took was Apple. And we were able to scale out of Apple, move to a break even, and by that reduce our position size. All the boxes were checked for reducing risk, less exposure, already booked a win, on half of the position. And now we can see how high is high, right? Same idea. MG, can we find a relative outperformer? Hey there, Off-Road Bear. BSX. It's still a trend. Off-road bear, I mean, you're in from February, right? So my question is, have you paid yourself? And in paying yourself, you've moved from break even to a tightened stop. You know how much unrealized profit you're willing to give up. I don't know if it's a daily time frame you're playing or if it's a weekly, because obviously that's going to make a difference in terms of the structure of one time frame versus another. And then, what are your next targets to scale out at? And then where's your trailing stop? I don't know that I want to see this thing break $50, to be quite frank. And specifically, what is that? What would that number be? I'm looking at the Wednesday, April 26 low. Yeah, I would like to see it to stay above that Darvis level. I'd love to see it to stay above the 50 psychological level. If it can do that, give it some latitude. I think a lot of times we want to take advantage of a larger trend, a multi-month trend, multi-week or multi-month trend. We can't smother the stock or the ETF or the futures contract. There's no perfect way to say that's enough room, that's not enough room. But I'll say at this point, I think 50 would be a pretty reasonable place to say, look, if we lose control there, if there's a little bit of a volume ledge in that area, if the buyers don't step in with that demand, I'm probably going to see stops run on the south side of 50 is my thought. All right. Hey there, Stephen. I am having a great day. I am. Thank you for asking. I was wondering, when you are day trading, do you focus on futures or stock options during the morning in your room? Stephen, I do both. If you head on over to the Simpler Trading YouTube channel, Friday's video is I do a recap for the folks in the mastery. We do a video, and I've been incorporating software over the years that track the trades and allow me to analyze my trades. And I've really settled on I've really settled on TradeViz. I've had that running on and off, so probably the last 10 months or so. And I really started to take some more time to use it more. And you can see what we did and on the future side. And then going forward, I'll do it for futures trades and the stock trades. So when we have an alert that goes out to members, that gets logged in, and we can start to show you, how I'm doing with those. And so with that said, Stephen, I don't really believe, I love trading futures, love them. That was my first type of trading. I've been trading for a long, long time. I started day trading, Stephen, in 97, but I was already swing trading and playing stocks and options and futures before that, right? So I kind of have a soft spot for those markets and for the overnight. But as far as day trading goes, I know two things. One, futures are ridiculously leveraged. They're very, very risky. I don't care what anybody says. I really do not believe that mini contracts are easy to control risk, because the typical price movement at $50 a point, a lot of accounts could be gutted with a number of E-mini S&P NASDAQ contracts. Micros are great. A lot of folks don't like them because the commissions are meh when you think about how much the move is on a micro as opposed to a mini. So a lot of folks don't want to trade micros. I didn't have micros coming up through trading. In fact, the only S&P I had when I first started was the large S&P contract, right? The E-minis only came along in 99, right? So they're kind of a young-ish new contract. Before that, it was the big contract. It was a pit traded contract. All right. So that said, what I really encourage a lot of traders to do when they're getting used to trading the S&P is trade SPY calls and puts. Open up a cash account and trade long calls and long puts in lieu of those heavily leveraged futures. So here's how I do it though, Stephen. Let's say, for example, I was going to set up a buy at 42.23 and a quarter. I want that Darvis low. I like that wick. That's where I want to get long the S&P tonight. For example. All right. What I would do is then, and the way that I alert it out is limit buy ES M23 4223.25. Okay. Or, and the rest of the alert reads, or buy SPY, right? And if we're talking about Tuesday's expiration, that would be 5:30. So you'd buy the May 30, and those just expire that day because I'm day trading. I don't need to pay for a whole bunch of time, right? Why pay for that time as part of premium? So I'd buy the May 30, whatever that call is, 422 call, 422 call, whatever that would correspond with, that I'm at or slightly in the money, not out, right? And then that would be the corresponding call. So anyone who wants to trade SPY, the only reason I even have to pull that symbol up is to figure out what would be an at or slightly in the money call, right? And that would coordinate with where ES triggers that limit buy. And then I leave the SPY and I watch the ES. I don't look at the SPY again until I pull up my order entry platform to put the order in to buy that ETF call to look at the bid, ask, and the last. I'm really not tracking or even setting up the trade on the SPY. And if you think about it, the more complete view of the S&P is the futures contract. These are nearly 24-hour contracts now. At 9:30, I've already got a running start with my indicators, as opposed to at 9:30, boom, everything starts to sort of calculate with volume. So I love using the futures as a proxy for every other kind of variation of that symbol. So for example, with crude oil, USO, micro crude, I'm still looking at CL. For the S&P, SPY, SPX, MES, I'm still looking at ES. So I'll put the alerts out for both, but here's the caveat. Only so long as the strike for that option has sufficient liquidity, right? And when we're talking about the SPY, that's never really a problem, but that's the way that I do it. So I'll set both out. And because we're looking ahead of time to levels that we have predetermined, whether that be volume, volatility levels, Darvis, whatever it is, volume, anchored VWAP, whatever it is, because we know what those levels are ahead of time, I can place the limit order to buy or sell. And then I can also either place an alert or then spend some time getting ready, looking at bid ask last to buy that option as we close in on that level on the futures. That's how I do it. I don't really look at the SPY for anything else other than what strike and what do you cost when I want to buy it. All right. Okay. Very cool. Okay. So that's, sorry. I did spend a little bit longer on some of those questions. Sorry about that, gang. And the 30 minutes flies so by quickly. All right. As always, gang, thank you for joining me for this week in the market live. We'll be having charts. It's so funny. I'm going to call tomorrow, Monday, all day long. I know it. I'm going to. We'll have our charts and coffee Tuesday, the 30th at 9 a.m. Same time, same channel, 9 a.m. to 9:20 as we do Monday through Friday. And I'll see you then. If you have any questions, get them in early. As you can tell, I just go from first come, first serve, top to bottom. As always, thank you so much for your time. And thanks so much for love and trading. My heart is with the retail trader. That's what I do. And so let's turn the corner together. Let's keep turning that corner and getting better and better. All right, gang. Be good to each other. I'll talk with you tomorrow.